and presently posted as branch head of New Delhi branch. And today we are going to discuss understanding risk involved in export credit guarantee. So friends, understanding the risk involved in export credit guarantee in an increasingly interconnected global economy, export credit guarantee plays an important role in facilitating international trade. It involves certain risks also that we have to take care of. As chartered accountant who are known for their financial acumen and consultancy, today webinar will make clear the complexity of export credit guarantee and its complication for businesses. We delve into the intricacies of these risks and explore how our members can guide their clients and manage their risk. And also, members, I want to update all of you that next Thursday, again, evening 3 to 5, we are going to have a discussion on startup. And today we have with us CA Manoj Lambaji. He is also very expert in MSME and startup. And next week, he is going to take the session on startup. And now I request CA Manoj Lambaji to please take this webinar forward.
Good afternoon, everyone. I take this opportunity to introduce the guest speaker of the day, Shri Rahul Ji. Shri Rahul Ji is a Deputy General Manager of ECGC, Export Credit Guarantee Corporation, and presently posted at branch head of New Delhi branch. After graduating in science with physics as major subject, he started his career with ECGC in 2001. He had also done post-graduation certificate course in finance from IIM Indore. He is currently doing an insurance fellowship program from Indian Institute of Insurance. He has more than 22-year experience in export credit insurance and has also worked closely with various stakeholders in export business at Delhi, Muradabad, Ludhiana, Jalandhar, and Mumbai. Being in charge of project expert department of ECGC, he was responsible for operation of the NEAI Trust of Government of India. National Export Insurance Account is a trust set up by Ministry of Commerce to promote project exports and administered by ECGC. He was also a member of working group of Project Export Promotion Council of India. He was the resource person from ECGC for International Working Group since December 2017 and was involved in formulating India's views on pricing of insurance premium and the pricing of funding. With this word, I introduce Shri Rahul Ji and request him to give his deliberations. Welcome, sir.
Good afternoon, everybody. At the outset, I would like to extend my warm greetings on behalf of ECGC Limited that the Indian Chartered Account Institute has given us an opportunity to interact with the most eminent and most important people of the country who are driving the economy of the India. And without recently I remember one speech from Mr. Narendra Modi also said that the Prime Minister's signature doesn't have so much of value as CA's signature, the signature of the CA, that the value it carries. So I'm very lucky that I have been given this opportunity, that this is something where you are promoting the startups. In the last 2 days, there was a startup Mahakumbh going on in Delhi, which was yesterday. There was a culmination program which was attended by the Honorable Prime Minister of India, Shri Narendra Modi ji, and ECGC was very proud that we were associated with that startup Mahakumbh. And I was also got an opportunity to be part of that startup Mahakumbh. So we have been closely watching the startup, and so thank you once again for giving us an opportunity. So I would just like to request that deliberation should be entirely in English or can be Hindi or English mix both. If Dr. Raj Chawla, or Mr. Lamba, if you can.
As you are convenient, sir. No issue.
No, since the participants are entirely from Delhi, then it can be a mix. If like
Yeah.
they have joined.
You can make it mix, no problem.
Okay.
Yes.
So first of all, since this is a startup meeting, first of all, I would like to tell you, because for most of them, this ECGC would be a naive subject, because most of you might not have heard about the ECGC. Like when we ECGC is a Government of India institution. It's a PSU, public sector enterprise undertaking. So what happens on the lighter vein, I must say that we are also like governed by audited by the CAG, and we have when CAG appoints the statutory auditor that conducts the audit after at the end of the March. So we have seen, like whenever the new firm CA, whosoever comes to us audit, they are also hearing the ECGC for the first time. So at the outset, I would just like to explain what actually ECGC is. Now, ECGC, previously it was called ECGC, means Export Credit Guarantee Corporation of India Limited. So now Export Credit Guarantee Corporation could be like Export Credit Guarantee Corporation of Indonesia Limited, also Export Credit Guarantee Corporation of Pakistan or Sri Lanka. That could be of any country. So what happened in 2013-14, and nobody used to call it an Export Credit Guarantee Corporation. It used to be called ECGC. So ECGC sort of have become a brand name. Like if you see in the past, the telco, it was like called Tata Engineering Locomotive Company, but the brand name was like Tata Motors or something like that. So what happened of late, the Tata, instead of calling telco, is rechristened it to Tata Motors. Similarly, to give this brand and identity, we were also like from 2013 and 14, we were like rechristened ourselves, and now we are called ECGC. So that ECGC acronym has no longer any meaning. It's ECGC is a brand name. The ECGC Limited is of, when you say, it doesn't mean Export Credit Guarantee Corporation. It is ECGC Limited. So basically, ECGC is an insurance company, first of all. What ECGC is? It's basically an insurance company. Now, what type of insurance we do? It's a unique thing that we provide coverage against the non-payment risk. Now, non-payment could be of two types. Now, ECGC has a two clientele base. One clients are the Indian bankers, and second are the Indian exporters. Now, when the Indian exporters approaches bank, and then they take a finance from the Indian banks, and suppose tomorrow if they are unable to pay back the loan to Indian banks, then if the Indian bank has taken a cover from ECGC, we compensate to the Indian bank against the non-payment by the Indian exporter. So that's a one forte that we do cover. Now, second line of business is we provide insurance cover to the Indian exporter against the non-payment by the overseas buyers. So basically, if any Indian exporter is making shipment to, say, if any XYZ buyer in USA on a credit terms, suppose agreed terms of payment is a 60 days or 90 days of credit. Suppose that buyer does not make the payment, then ECGC compensates the loss to the Indian exporter, provided they have taken an insurance cover from us. So this is primarily the basic role. In a very layman's language, I have tried to explain to you what is the basic role of ECGC. Now, in next 1.5 hours, I will run through the presentation, because the topic of my talk is how to manage the risk, how the export guarantee plays to mitigate the risk of an Indian exporter. So I'll just share the presentation first. Sharing my screen. starting with our presentation, ECGC is a Government of India enterprise which is headquartered in Mumbai and it is spread all across India. So we have our presence across all the major export centers of India. And we endeavor to support Indian export industry with our experience, expertise, and undying commitment to progress and advance. So our company was established in 1957. So it has been more than 66, 67 years we are there into the service of exporters. To start with, just I will tell you that for any country, if the country wants to grow, like if you can, example of a China in the past 20, 30 years have grown like anything. It is just because of their exports. They have earned so much of foreign exchange reserves, and that is why the country has grown leaps and bounds. So for any country to grow, your export should grow. Your balance of payment should be like favorable. When I say balance of payment, your export should be more than your import. Right now, what is happening? Our India import is more than the export. So our balance of payment is unfavorable. So a country is called to be developed when the balance of payment is favorable to their side. So to promote export from India from any countries, normally government they established an ECA. ECA, what I mean is an ECA means export credit agencies. Now export credit agencies can have their roles are defined. One is you are into finance and one you are into insurance. So India have two ECAs. The ECS for finance is rest with Exim Bank of India and providing insurance rest with ECGC. In some countries, one institution play the dual role. Like if you say go to USA, it's called US Exim. Now US Exim is also into financing also, and the same time it is also provides the insurance also. So what is our vision statement? Our vision is to excel in providing export credit insurance and trade-related services. And what is our mission? Our mission is to support Indian export industry by providing cost-effective insurance and trade-related services to meet the growing needs of Indian export market by optimal utilization of available resources. When I say cost-effective, see, I joined this company in 2001, and it has been more than 22 years now. I haven't seen any upward revision in premium because it's a Government of India company. So we are not there to a motive of profit making. Our mission is to support the Indian export industry. So in past 22 years, since I joined, I haven't seen any upward revision in the premium rate. On the contrary, there has been downward revision twice in our premium rates. Our premium rates have been slashed down, one in 2007 or 8, and secondly in 2017. So that is what means we have gone by our mission statement. Now, this company, as I said, I explained Export Credit Agency. It was set up under the Companies Act in 1956. It's 100% owned by the Government of India, and we are under the administrative control of the Ministry of Commerce. Then we are governed by the Board of Directors. Now, Board of Directors are like our CMD. Then we have some participation from Exim Bank, the Scheduled Commercial Banks of India, means public sector undertaking banks. Then we have a representative from Reserve Bank of India. Then we have a representation from ministries of Ministry of Commerce, Ministry of Finance. Then we have a Board of Directors from the various Export Promotion Council. Suppose since you are all a startup, suppose anybody is like intends to start a business, say in the terms of ready-made garments. Now, to have a proper access to the market and you want to meet the buyer, you need to register yourself with the Apparel Export Promotion Council. Similarly, you have for agriculture produce rice, you have a Export Promotion Council called APEDA. If you are going to export leather goods, then you have to register with Council of Leather Exports. So there are various councils of under various commodities, and all are formed by the Ministry of Commerce. So representation from these Export Promotion Council are also nominated as a Board of Directors to the ECGC. And I said you earlier that ECGC being an insurance company, it is regulated by Insurance Regulatory and Development Authority of India. And just to inform you that ECGC has been given IAAA rating by ICRA. ICRA is a rating agency. IAAA rating means it denotes the highest claim paying ability of ECGC. Now about us, what we have been doing in the past, like we have been awarded in 2022, 3 and 18-19 CFBP Jamnalal Bajaj for our fair business practices. Then we are 100% gone by the Government of India. Last year only we have been awarded Niryat Bandhu Gold Award by FIO from the Honorable Minister of Commerce and Industry, Shri Piyush Goyal ji. We have been winning the Rajbhasha Puraskar for promoting Rajbhasha for the last 25 years. And we have been rated excellent as per the Memorandum of Understanding by the Department of Public Enterprises for the financial year 2022 and more recently 22-23 also. We have been rated excellent. So this is this speaks of the services and what the ECGC does. Now this is our functional structure. At the topmost, we have a chairman come managing director. Then under them are 2 executive directors. They all sit in Mumbai. And then we have various sectors. As I told you that our mainly client deals, our clientele base are bankers and Indian bankers and Indian exporters. So we have divided both the sectors. One is policy matters, which are company secretariat, marketing division, or your legal RTI. And other sector looks after the entire business portfolio of the company. Now, this is just a glimpse of the services network. As I told you, we are present at almost all the export centers of India. In North, we are having one regional office also. That is also headed by a DGM, where we have various branches also. And this New Delhi branch is a big branch. It directly reports to the head office. So we have a presence almost at all the export centers across India. Now, just to give you the snapshot, what our business profile is, exporters, how many products we do have for the exporters. If you are seeing in my screen right now, we are mentioning that short-term policy, short-term ECIB, medium and long-term MLT, what we have written. Just to explain you what it is, see, RBI, Reserve Bank of India, what it says that any export, whatever you are exporting, the payment should be realized within 270 days of your shipment. That is the standard guidelines, what the RBI has prescribed. Now, you cannot make a shipment where you can give terms of payment where the payment realization is beyond 270 days. So that is not allowed by Reserve Bank of India. So any payment for the exports that is getting realized within 270 days are short term. And any payments, let us not say 270 days, you can keep it to 1 year. But RBI prescribed it is 270 days. Now, any payment beyond 1 year, if it is getting realized after 1 year, is classified as a medium and long-term MLT. So these are the basic difference. Now, coming to it, the second question, once your question would come to your mind that can you export, say, some ready-made garments or shirts or any ladies' garments to any of the export buyer in USA, say for a credit period of 360 or 540 days? No, because as per this, it can be classified under medium and long-term exports. But I'm sorry, you are not allowed. For medium and long term, where the payment terms of payment or your payment realization period exceeds 1 year, you are only allowed to export capital goods from India, or any, if you are constructing or you are doing any EPC contract. EPC is erection, procurement and commissioning. Sorry, engineering, procurement and commissioning. If you are doing any such contract overseas, then your payment realization can extend beyond a period of 1 year. So RBI also allows that. So those are classified as a medium and long-term exports. And what is policy and what is ECIB? Policy is when we provide insurance cover to the Indian exporters, and ECIB is the acronym. The ECIB means Export Credit Insurance to Banks. As I said, that we have two client. One is exporter client base. One is exporter, Indian exporter, and the Indian banks. So to the Indian exporters, the insurance cover which we issue is called a policy, and to the banks, the insurance cover we issue is called Export Credit Insurance to the banks. In short, it is called ECIB. So business profile, if you look at the number of products, what we do have are 20 for the short-term policy. A number of policy covers that we have issued. This is a business data of 22-23. So 22-23 number of policy covers we have issued is 11,000 plus. A number of exporters associated with ECGC are 7,000 plus. Similarly, for banks, we have more than 11 products to the bank, export credit insurance to the banks. And number of accounts covered are 13,000 plus. And number of exporters covered under this category are 9,000 plus. Now coming to medium and long-term exports, we have 13 products that those are there as of now, and we have issued 194 covers. We have provided cover to the 8 banks also, and of the number of exporters that we are covering under the medium long-term export as of in 22-23 were 51. Now this is the product. See, for if you see on the right hand side, the last year premium income was 1,197 crore. So for earning this premium, we underwrote the total risk value is whopping 6,63,602 crore. So to turn this much of amount of premium, 1,197 crore, we underwrote a risk of almost 6,63,000 crore. Now risk value, if you see, in terms of ECIB, that is to the banks, the risk value covered was 3,38,000 crore. The policy, it was 3,21,000 crore. And medium and long term, it was 2,850 crore. Similarly, you will see the premium distribution also. Policy, the premium was 540 crore. ECIB, it was 632. And medium and long term, it was almost close to 25 crore. Now, if you see the year 2022-23, the total claims that we paid was 763 crores. Out of this, 763 crores, 415 crores were paid to the Indian banks that you can see the marked in the maroon color, ECIB. Then under the policy, we paid almost 190 crores. And in the MLT sector, if you see, the premium earned, what we earned was 25 crores, but where the premium what we paid was, a claim that we paid was 156 crores. Now, on the right-hand side of the pie chart, it is called recoveries. Now, it's a credit insurance business. It's a very niche area. So what happens is that suppose if we pay claim to the bank, Indian banks. So what happened? Suppose, let us take any example. If any of the bank defaults, if any of the exporter defaults to the bank, what bank does? They classify the account as a NPA. Now it goes to NCLT or they go to DRT, whatever the case may be. And then bank definitely have some collateral also. Sometimes collateral may be adequate, it may not be adequate. So what they do, by the time they classify NPA, they lodge a claim with ECGC. Suppose the total loss was left 5 crores of rupees. Now ECGC under ECIB export credit insurance to bank, normal our indemnity, the percentage cover is 75%. So say we paid them to 3 crore 75 lakhs to the banks. Now say after 2-3 years, 4 years, the DRT, the case was resolved. The bank was able to dispose the collateral what they had taken as a security for their loans also, for their loans. So what they have, once they sell off the asset, dispose the asset or whatever it is, they recover the amount. Suppose the total recovery is say 1 crore by disposing the asset. So what will happen? Since we have paid 75% of your loss, say we have paid 3.75 crore against your total loss of 5 crore. Now, since you have recovered 1 crore, you will have to share that recovery with us. So you will have to pay 75 lakhs back to ECGC. So this also constitute one of the income of ECGC. So if you see the such type of recoveries where we have paid the claim in the past, so last year our total recovery was 169 crores. You can see the most of the recovery comes from the ECIB sector because the recovery operates here in Indian ecosystem. Bank has taken the collateral and all. So they can whenever they dispose, we also come to know about it, and the recovery is shared. So the recovery share of the total recovery is maximum from ECIB. Vis-a-vis, if you see the recovery from the under the policy sector, it is 10 crore only against the claim payment of 190 crore. Why it is that? Because the buyers are situated overseas and we do not have any control, and we do not have any overseas offices also. So it's really difficult to have a track of that recovery. Only when the exporter is following up with those buyers, they are able to get back some recovery. And whenever they get the recovery payment from the buyer, they also have to share the medium and long-term recovery is on the higher side, because normally for medium and long-term side, this I will come later on, just to give you an idea why it is on the higher side if you compare in the terms of risk value or premium, whatever we earn. Because now medium and long-term, it is not one-to-one individual. Normally, medium and long-term project export, which we call medium and long-term, we say it for the project exports. That I will deal later on in my presentation. So medium and long-term export is basically a government to government. It's basically the government. Your export is mainly to the government agencies. So there are fair chances of getting back your recovery. I will stop here one for a second. Am I audible or am I clear so far? Hello?
Yes, sir. You are properly audible and everything is clear.
Thank you. Now coming to the financials and performance, which since all of you are CA over here, this will be like a more of a, you will be more keen and anxious to look. See, our total premium income was last year was 1197 crores and claim paid was 763 crores. And recoveries, we made 69, and operating expenses towards the salary and everything was 308 crores. Our profit before tax was 2,761 crores. Now, you would imagine with the premium income of 1197 crores, where did this profit of 2,761 crores? Now, see, I said that we are a company which is 100% owned by the government of India. Over the years, our authorized capital is almost 10,000 crore, and so far the paid up capital is more than 5,000 crores. And over the years, whatever profit we are earning, and we have the liability on the investable income, what we do have right now is close to 15,000 crores. So our major source of income is from investment income. So that forms a major source of income. It's like almost at par with our premium income. So with that, we are able to generate so much of profit. If you see, the last year we have paid almost 434 crore of dividend to the government of India. So that is the major. If you see that figure of 2,761 crore of profit, it is basically because of the return on the investment income what we do ECGC have. Now coming to the most important, which we had, like, this was just a brief about ECGC, what ECGC is. I hope you are clear to like what is the role of ECGC here. Now, what are the risks in international trade? Now, once you're going to a startup, since you are like going to a startup, or you might have started a new startup. So there are a few types of risks which are like involved. One is credit risk. What does mean credit risk? Because international transaction is not like a domestic transaction where you go to the market and you pay the money and get your goods. You have to deal on the credit terms, either through bank to bank also or directly also, because the buyer was not going to pay you in advance in most of the cases. And to compete with other countries and all, you may have, because what USP you may have. Suppose if you're not competing on price, because of China, they have so much of like volume, we cannot compete on price. So India, what the advantage India does have, it's like a quality of the goods. But quality is there, but nobody is going to, they are ready to pay you even the higher price also for the quality part. But they want certain things because they also require money. They also want to sell that goods and then earn the money and then repay you. So naturally, the credit terms of payment is one of the, what you can say, the necessity which every exporter starts with, because then only you can compete in the international market. So credit risk is one of the most important risks, and this is one of the unique type of risk which no insurance company would cover. So ECGC will provide you such type of cover. Then you have a shipping risk. Any losses that happens in the way of transit, either it is like you have been hearing like the Houthi attacks in the Red Sea, or recently that we are hearing in the news, the Somalian pirates, or goods is like ship sinks somewhere in between, goods, entire good has resulted into loss. So these are some of types of risk, or there is a theft, or in the mid between in transit only. So these are some type of risk which are classified as a shipping risk, where the insurance can be taken from the general insurance company, New India, Oriental, or whatever it is. Then you have a foreign exchange risk. Now, suppose what happened here, since the payment has to be repatriated back to India in the convertible currency, be it euro, pound, dollar, or Australian dollar, Japanese yen. Where there are 7 or 8 convertible currencies, you cannot not going to accept the payment in the local currency from Sri Lanka or say Egypt or any other countries. It has to be in with those convertible currencies only. So what happened in those cases? Suppose your shipment, you have made a shipment of, say, today. You have procured the order, say on say whatever, since the order received from the overseas buyer on dollar terms. So today $1 is almost 80 rupees. So you calculated your profit and you made your own calculation and you procured the good, and after calculating, you made the shipment. Now payment has to come after 90 days. So 90 days, because of any turmoil or geopolitical risk, if the dollar price increases, suppose it goes to from 80 rupees, it goes to 85 or 90, then so you are in gain. But suppose if it goes other way around, suppose it goes to 75, definitely for $100 shipment you might have calculated in Indian rupees, you will run into losses. So normally in that word, they exporter, if you are dealing in large foreign currency, they do a forward booking, or it is called hedging also. So this type of risk is mitigated if you have a product from the Indian banks. Banks provide this hedging risk. If there is means you can cover your foreign exchange fluctuation risk. Then you have a country and political risk, like we saw recently. Our shipments were going to Ukraine and Russia, and all of a sudden war broke out. So that was something called country and political risk. You cannot have a control over that. So this type of risk again can be taken care by ECGC. Now you have an intellectual property risk. You cannot infringe upon them. So these are, again, you can avoid this risk by consulting your legal expert or somebody. Like if you have a normal patent company who provides expertise on it, this can be taken care by them. Now again, it's the same. It's a commercial risk. It's a commercial risk when we say commercial risk, risk in international transaction. When we say the pure commercial risk, when we are doing a business for Indian exporter. Now, what are the risks they run? One is commercial risk. Commercial risk is when the risk is purely on the overseas buyer. Suppose the buyer becomes bankrupt. Suppose the buyer willfully does not pay you, or buyer cheats you. These are classified as the commercial risk. The risk is purely on the buyer. Then you have a country risk. Country risk because of some political situation. Like I will give you an example. In recently, what we have come across within our experience, Egypt, the buyer is good. Buyer may be very sound, but that country is short of foreign exchange reserve. So even the buyer has made the payment in their bank in the local currency, but that country is not having enough foreign exchange reserve so that payment is repatriated back to India. So this is country risk. Suppose you have made a shipment. I just give you an example. We have provided a cover to one of the Indian exporters who was doing a project of transmission line in Afghanistan. Now that project was World Bank funded. So what happened on 14th August, I think 2021 or 2020, I'm not recollecting. All of a sudden, American troops withdrew from there, and in no time, on 16th August, Taliban took control of entire Afghanistan, and they even asked all the Indian exporters who were doing the projects over there to vacate the country in no time. So what happened? They had to leave their goods behind and all. Everything was stuck over there. They did not get the payment also. The government also changed. Taliban took over. So this is a country risk. So if you had seen in my slide of the claim payment, the total claim paid under MLT, the medium and long term segment which I indicated was 156 crores. So that was pure basically on because of that Taliban issue, we had to pay the Indian exporter here a claim amount of 152 crores. So that was the major amount. So these are the country risk involved. And foreign exchange risk, already I've told you the exchange fluctuation. So first two risks, commercial risk and country risk, can be taken care by ECGC. And foreign exchange risk, it can be, you can get it managed from by taking a proper buying a proper product from the Indian banks. Now, how the risks are managed? Now, what are the types of risk which are covered by ECGC? Now, if you see this thing, first part, I am dealing only with the political risk. When we say the country risk, by country risk, we mean it's a political risk. Now, country risk is a political risk, and the risk on the buyer is a commercial risk, and cumulatively, as a whole, it is called a comprehensive risk. Now, what are the risks that do ECGC cover under for the short-term policy for the exporters? It is nationalization, expropriation, or sovereign acts which in their effects are equivalent to expropriation. Expropriation, suppose you go to Africa, you took a mine on a lease, say for excavating any precious metals, or government of that country has given you a lease. Now that you are there for 10 years, 15 years, or 20 years or so. Now what happened? There is a change in a government in that African country. Now African says, nothing doing, no more lease. Now this lease, all these mines will be nationalized. We are taking your config is that seizes your mine that was given in the lease by the previous government. Now that is a nationalization or expropriation. That's a sovereign act by the government of that country. You can't have any control over that. So this is one of the risks that is covered by ECGC. Second is war risk. As I said, war or armed conflict. I gave you an example of Taliban issue or Ukraine or Russia issue. If your goods have reached there and our payment is stuck up because of any war happening in that country, so that is under the war risk. Then diversion of voyage. Though you might have read in the newspaper in the recent past, what is diversion of voyage means. Suppose you read about the Red Sea in the past. There was an attack by the Houthi rebels in that sea. So Red Sea is the most convenient route which the Indian exporters, the shipping lines, they do take. But because of this, Red Sea was put out of they were not allowed. So this shipping company had to take a longer route, incurring more fuel charges, and ultimately those charges are passed on to the Indian exporter. Suppose as of now, your shipment has already started, and there is a sudden blockade in the Red Sea, by which the shipping line had to take some alternative route, incurring more cost. That is also one of the risks which nobody has any control. So those risks again are covered by ECGC if the exporter incurs some additional cost because of diversion of voyage because of political reason. Then you have a transfer delay risk. Transfer delay risk, I already told you about that Egypt issue. Like Egypt, what we are hearing recently, we had in Sri Lanka also. Now, Sri Lanka buyer may be very good. They are ready to make you the payment, but the country is not having enough foreign exchange so that payment is repatriated to India. So this is transfer delay risk. This is not something to do with the risk on the buyer because the buyer has already made the payment in the local currency. But the country is having a shortage of foreign exchange. So that is why the payment is not coming to India. This is classified as a transfer delay risk. Then you have import restriction risk. So I will just give an example. In 1998, when India had conducted that Pokhran nuclear this thing. So what happened? Already some shipments were on high sea going to USA. So all of a sudden USA imposed a restriction on India. The shipments which were already on the way were not allowed because there was a restriction imposed from the immediate effect. So either goods have to be recalled back to India or it has to be diverted to some other countries to be resold to some alternate buyers. So because if you are recalling back good to India, then also you are incurring some additional charges, your freight charges, or if you are diverting it to some other country also, then also if you are selling it to some alternate buyer, definitely your alternate buyer is not going to pay you the same amount which you had agreed with the original buyer. So there also you ran into losses. So these are some of the risks covered by ECGC, and these risks are classified as a political risk. Now, what are the commercial risk? Now, commercial risk is, again, when you do the international trade, the payment route either can be through, it has to be some bank only. But there are like just I will let you know what are the terms of payment we are doing in the transaction. First is advance terms of payment. Now, advance terms of payment means if your entire payment for the shipment is realized before the bill of lading जैसा आप बोलते हैं ना, अब हम ट्रक में देते हैं बिल टी, तो बिल ऑफ लेडिंग की डेट से अगर पूरा का पूरा पैसा पहले आ जाता है तो दैट इज टर्म्स एंड एडवांस टर्म्स ऑफ पेमेंट. सेकंड होता है डीपी और सीएडी. डीपी मींस डॉक्यूमेंट अगेंस्ट पेमेंट और सीएडी इज कैश अगेंस्ट डॉक्यूमेंट्स. बोथ आर द सेम थिंग. होता क्या है कि व्हेन एक्सपोर्टर एक्सपोर्ट्स फ्रॉम हियर, यहां से उसने एक्सपोर्ट किया, वो क्या करता है कि क्योंकि आपकी शिपमेंट वहां पर जो होता है कि वो बिल ऑफ लेडिंग के बेसिस पे ही छूटेगी बिकॉज इट्स अ निगोशिएबल डॉक्यूमेंट. तो आपका एक्सपोर्टर क्या करता है यहाँ पर, दे सबमिट द एंटायर डॉक्यूमेंट्स. एक बिल ऑफ लेडिंग की कॉपी लगेगी, एक इनवॉइस की कॉपी, पैकिंग लिस्ट की कॉपी, सर्टिफिकेट ऑफ ओरिजिन, जो भी रिक्वायर्ड डॉक्यूमेंट्स होंगे, दे विल सबमिट टू their bank in India. Now, Indian bank, what they will do, they will send that entire bunch of documents to the buyer's bank. Now, buyer, when it reaches the buyer bank, as the terms mentioned DP and CAD, that means document against payment or cash against documents. So what will happen? They will make the payment. Only after making the payment, the buyer banks will release the documents to the buyer. Once the buyer gets the document, he can get the shipment released. Now, after that is CAD. CAD, I'm sorry. It is DA. DA means document against acceptance. Now, the mechanism remains same. You submit your documents to your bank will send the documents to the buyer's bank, and there the buyer will come. He will not make the payment. He has only to accept the documents and take the documents from their bank. The payment will be after 30 days, 60 days, 90 days, 120 days, as per the agreement between the exporter and the buyer. So after that 120 days, the export buyer will make the payment. And if he doesn't make the payment, then ECGC comes into that to the rescue of the exporter. So this is document against acceptance. Now, going beyond that, then you have a open account terms. Now, in open account terms, there is no bank intermediary bank involved in between. Now, exporter send documents directly to the buyer. He couriers it directly to the buyer, and against the receipt of the document, the buyer gets the shipment released and will make the payment as per that. And if the shipment is going by air, if your shipment is going by air, even if you are sending the documents through bank, then also it is classified as an open account payment. Why? Because document will reach in 7 days or 10 days. Your shipment will reach before that. And since airport being a very high sensitive zone, just based on the undertaking by the buyer, the shipments are released. So there is no sanctity of, even if you involve the bank in between, the airline will release the goods just based on the undertaking. He has to prove that this good is consigned to me, and based on my undertaking, you release the shipment. So even if the shipments are going by air, even the banks are involved in it, there is no meaning of it. It is classified as an open account terms. Then you have a LC terms of payment. LC means letter of credit. Now, letter of credit, what does it mean? I'm Indian exporter here. I say buyer is asking for some goods from India. I say that I do not trust you. I will not neither give you any credit or something like that. Buyer is also not ready to make the advance payment because he also does not trust the Indian exporter. Because if you keep my money and walk away with money, what will I do? So what will the buyer do? And what they come to an agreement, buyer will go to his bank in say in USA. He will get a letter of credit issued in favor of this Indian exporter. And there are certain terms and conditions stipulated in the letter of credit. As soon as you comply with those terms and conditions, because it only says when you make the shipment, the bill of lading is the most important document in that, so that payment will be made by that overseas buyer under that letter of credit. So it is safe mode of payment. Now, if you see for the terms of payment which I mentioned, advance being the safest, LC is also safe. Now, if you see the DP or DA is the less risky one. If you go to DA, it's more risky. If you go to the open account, it's the most risky. So these are some of the terms of payment which are prevalent in the international commercial terms. So the first risk under the commercial risk that is classified is default by the LC opening bank. The LC opening bank does not pay because there could be a chance where LC opening bank may default. This normally happen in Latin American countries or African countries. Default of the buyer, inability of the buyer to pay on due date due to commercial reason. Then insolvency or bankruptcy. On due date of payment or before that your due date of payment, the buyer goes insolvent. You have very chapter means a ruling in USA or UK. There is a chapter 7 in UK and European Union and chapter 11 in USA, where bank can file a bankruptcy. Unlike India, where bank declares NPA, on the contrary, in these countries, the buyer can file a bankruptcy. Once it files bankruptcy, it has no legal obligation to make any payment. Then the administrator, whosoever is appointed for that from the liquidation court, they will classify which of the the debt are the secured one, which are the unsecured one. So this in the recent COVID times, many buyers from the big buyers from USA, they became insolvent. Then repudiation risk, repudiation, failure of the buyer to take the delivery of the consignment, resulting the reimport. Suppose you have made a shipment from India, say to UAE, Dubai. Say the goods are rice. You are exporting a rice. Now you have some agreed terms of payment and you have made a shipment on DP terms. DP, you remember, it's a document against payment. Now you are also pretty sure I have played very safe. The document will go to the buyer's bank only upon making the payment. He will get the documents released and only after that he can take the shipment. But there could be chance the buyer does not turn up even to accept the documents. He will not make the payment. Forget about. Suppose his financial status or he has some other payment obligation to make, he is not in a position to accept the shipment. Then what will happen in those cases? Buyer will not accept the shipment. Then commodity being rice, it's for all the commodities. I'm just giving an example of rice only. So you will have to recall the goods back to India, or you will have to find some alternate buyer in UAE or some other neighboring countries, or maybe some far off countries. Now, what are the losses which you may incur? Suppose you are finding an alternate buyer. Definitely, if your agreed terms of payment, agreed price with the original buyer was 100 rupees, definitely he's also going to take the advantage of that situation. He's not going to pay you 100 rupees. He will be paying you some 90 rupees, 75 rupees. So you have a chances of running into losses of 25 rupees or 10 rupees, whatever it is as the case may be. Now, your shipment is lying over there at the port. Now, once it is lying at the port, so it's not that you may be able to find the alternate buyer or some other buyer in a day or two. It may take 10 days, 15 days, 20 days. Now, once your shipment is lying at the port, because goods have not been released yet, so there are some detention and demurrages charges which you are going to incur entire the process. Or, so these are the losses. Or suppose if you feel that, okay, fine, I'm not going to find any alternate buyer, let's re-import the goods back to India. Now again, because you will be incurring some freight charges for re-importing your goods back to India up to your factory. So these are some of the charges which or the losses which may you incur, even the terms of payment is DP or whatever it is. Only in case of advances you are safe. So this is called the repudiation risk. Non-acceptance of good by the buyer. This is also classified as a commercial risk, and as I said, it could be a default of the LC opening bank. Similarly, it can be the inability or insolvency of the LC opening bank can also be there. If some banks become bankrupt, what we heard in the USA that Lehman Brothers, so if that of NBFC or something like institution goes bankrupt, then also you have every likelihood that your payment may not come. So these are called the commercial risk. My previous slide was on the political risk. These are commercial risk, and cumulatively, both are called comprehensive risk. So ECGC can provide you cover either on political risk or comprehensive risk. But if anybody wants to come to and say that I want cover only on commercial risk, that cannot be given. It has to be either political or comprehensive. Suppose an exporter comes says that USA they do not see any political risk. I want only commercial risk to be covered from on this buyer. So that is not given. It has to be comprehensive one. So this was basically the risk. So far it is clear. Hello. Am I audible? Mr. Srivastav?
Hello.
Am I audible, sir?
Yes, sir. Yes, sir.
Yes,
You're
sir.
clearly audible, sir. Please go ahead.
Because I had completed that political risk and commercial risk. Were you able to?
Yes, sir. We are getting a question from our participant that we will take up at the in last 15 minutes. Sir.
Sir, Mr. Srivastav, you are there on Mr. Srivastav? Mr. Dheeraj, CA, Mr. Dheeraj Srivastav. Sir, you please ring me on my mobile.
Hello.
Mr. Srivastav, am I audible? Sir, please do let me know if there is some break, means there is a internet disruption or something like that. You call me on mobiles. Otherwise, I do not come to know. Okay. Now, how does ECGC manage the risk? Now, suppose I cannot. So there are three mechanisms. One is country underwriting, one is buyer underwriting, one is exposure norm. Now, when I say country underwriting, what do I mean? Suppose I cannot, suppose I have underwritten a risk, I said 6,63,000 crore. Now, I cannot underwrite a risk of 5 lakh crore on one country. Suppose if that country goes bust, ECGC will be also be finished. So I have to maintain some exposure on every country. Suppose out of the total risk which I am underwriting, I cannot exceed more than 10, 15% or 20% on one particular country. Similarly, if there is any one of the buyer who is very much in demand, so I have to fix a certain exposure. Like suppose any of the buyers may be dealing of say 500, 600 crores from India, but I cannot have that entire 600 crores on that buyer because I have also to mitigate my risk. Because tomorrow, if something bad happens, so 600 crore if I'm going to pay on one buyer, so that is really like catastrophic from all of us. Then we have a exposure norm. How much exposure do we need to monitor? Or this is like a part of our risk management. How do we manage the risk? Because for an insurance company, the basic thing is your underwriting. Suppose you go for the health insurance also or the life insurance also. Suppose you ask for a very high value cover. The first thing they insist upon your medical checkup. They also want to, they are ensuring a medically fit person because they want to earn claim, but no insurance company wants to give a claim. It's not that they do not want. And in fact, on the contrary, I would say no insured also want to take a claim. But insurance should be there always for your protection. So as an insurance company, I cannot write everything in this earth or below this sky. So I have to also to manage the risk. See what happened in this case, in credit insurance, what happened? Unlike other insurance company, you have to, life insurance company, you leave aside life insurance, but most of the insurance company, they pass on the risk to other insurance company. Suppose ECGC is underwriting a risk, it's an insurance company. Now I cannot keep the entire thing in my book. What I do, I pass off my risk to some other insurance company. Those companies are called the reinsurance company. Now, reinsurance can be of various type. I'm not going to much detail into that. Suppose, say, I earn a premium of 100 rupees for underwriting a risk of, say, 1 lakh rupees. So what I do, I pass on my 20 or 30 rupees or 50 rupees of premium to the reinsurance company and ask them to say, in case of losses of 1 lakh rupees, you pay me 50,000. So this is how this credit insurance ecosystem operates. So what happened in this case? Suppose I have underwritten a risk of, so I also pass. But what happens in this case? The credit insurance company, they do not have a much reinsurance support in the market because the amount of risk which a credit insurance run cannot be compared with any other insurance company. So, but ECGC is fortunate that being a government of India company, and since government has entrusted so much of responsibility, and they have provided the adequate fund to us. So with that funding and all, we are able to underwrite the risk, whatever is coming to us, provided that risk is worth undertaking. See, now coming to the first part of it, say the country risk, how we manage the risk, country underwriting, then we had a buyer underwriting, then we have exposure norms. Now, export credit risk is the export business involves transaction with unknown entities in unknown territories. Now, coming to it, if you see in today's world, when everything is online, so a person sitting in India can do a business in a USA or any UAE or UK, wherever it is, even without knowing that particular buyer. So it involves a transaction in unknown entities in unknown territories. Then what are this? Export credit risk involves. One is commercial risk emanating from lending or business entity, reflecting the probability or otherwise of a firm to honor its obligation. Obligation is to make the payment. And this I already explained you all the political risk. So in its most basic function, export credit is a risk protection against any default, whether be it commercial or political. Now, political risk is also called country risk. Governmental, societal action and policy originating either within or outside the host country and negatively affecting either a select group of majority, foreign business operation and investment. It is the probability of occurrence of some political event that changes the prospect for probability for a given payment. Like what we saw in Sri Lanka, what we saw in Russia, what we saw in Ukraine, what we are witnessing right now in Israel and Palestine. These are something we do not have a control, but in every likelihood, your payment may get stuck in that country. Now, again, political risk can be like a macro risk, is a country risk, and micro risk. Now, if you see the country risk, again, is a systematic economic risk and system political risk. Now, again, the system economic risk could be macroeconomic imbalances. Like if you see in the major African countries, their debt sustainability is too high. Like your debt has almost grown up to like 75 or 80% of your GDP. So there is an instability in that country. Or the business environment in that country is not right. In case of like say Argentina, where the inflation is so high. So business environment is not conducive. So these are some of the economic risks. And political risk is systematic weakness. There is a frequent change in the government or the government effectiveness. There is a political instability. So these are called as a systematic politic risk, and these are analyzed as a country risk. So we have a special country underwriting department in our head office. So what happened? This country underwriting department, they keep on analyzing the country on a periodic basis. And what we do, we have classified the countries into 7 categories. Like 7 categories. The safest being A1, then comes A2, B1, B2, C1, C2, and D. The A1 is the least risky country, and the D being the riskiest of all countries. Now, your premium, what it happens, it depends upon your the country classification. The less riskier, the less risky is the country, the lesser the premium. The riskiest the country, the higher will be the premium. And this country classification is a periodic thing that keeps happening. And suppose normally it happens once in a quarter, but if you have some other information, so it can be done in between also. So that is taken care by our country underwriting department at Mumbai. And all other RBI and all other banks, they also take a cue from our country underwriting department. Which country, which has been classified according to which means their political and economic situation. Now, how this country risk classification is done? See, this is macroeconomic imbalances, currency inconvertibility or transfer restriction, or expropriation risk. Like if you go to the normally into the communist country, there is every chances of that your confiscation or seizure by the foreign government. Unanticipated changes in rules and regulations. Political violence, war, civil disturbance, military takeover, interruption or diversion outside the exporting country. So these are some of the parameters which we look into when we classify a country in their category, either A1, B1, B2. Now, political risk assessment is also taken. 3 C's are there: capital, capability, and character. Capital is your financial position, character, the intentions of the government, and capability, economic potential of that country. These are looked into for assessing any country. And why do we need policy? Because I said that we need to establish some premium rates, because I cannot have a same premium rate if the shipments are being made to USA, if I compare the shipment being made to Sudan. So can't we? Balancing internal portfolio, like we do need to understand how much risk we are going to take on which country. Suppose if I'm going to take a risk on USA, I can take more risk on that country. If I have to compare with the Sri Lanka or Egypt, I need to restrict my exposure on these countries. Determining country limit based on economic and political, that's what I said. Bearing on commercial risk is impact on the paying ability of the buyer or likely change in the government, its policy and regulations. This already I have explained you that its buyer may be sound enough to make the payment, but change in the government and policies may have a bearing on the commercial risk. Payment ultimately will not come to India. Ultimately, it's a commercial risk. The payment not coming back to India. Qualitative assessment to support the quantitative changes in the macroeconomic index. That's the qualitative assessment now, so that the risk can be quantified and quantitative changes, whether downgrading the countries or upgrading the countries, can be done. So this is something our head office does. This is the country risk rating model. So on the basis of this, we classified countries. This scorecard median. So a data-driven model is there. There are certain parameters which are fed into the system, and the computer populates which country is. So this is something our internal mechanism. I have kept this slide, but these are the CRM parameters these are the inputs which you need to put in the system. Economic risk, political risk, economic and political relations with India, ECGC's experience of other credit insurance. As I said that every country has two like ECAs, export credit agencies. So all the credit agencies across the globe, they form a union called Bern Union, and ECGC is also one of the member of the Bern Union. So on periodic basis, we keep exchanging the data among the various members of the Bern Union. So experience with other credit insurance also is one of the parameters on which country classification risk model is done. And forecasting like Moody's or S&P, these are some of the key rating agencies. Based upon their forecast, this data are fed into the system, and then a score is populated. I'll just show you. Suppose if your score is less than, I'll just show you next slide. If you see this one, A1 category, if your score is more than 90, then the country is classified as into A1 category. Between 85 to 90, then it is classified into B2. And you have a certain marks given assigned to each scorecard. So accordingly, the country is classified into the respective categories: A1, B1, A1, A2, B1, B2, C1, C2, and D. So A1 is classified as an insignificant risk. A2 this is classified as a low risk. B1 is moderately low risk. B2 is moderate risk. C1 is moderately high risk. B2 and C2 is high risk, and D is classified as the very high risk. So we have assessed 239 countries in 2023, and out of 77 countries were in insignificant risk, and 23 countries were in the very high risk zone. Now, this was the risk, how we assess the country risk. Now, similarly, we have a similar scorecard model on buyer underwriting, because these are our underwriting tools. Now, coming to buyer underwriting, again, we have a dedicated buyer underwriting department at our head office in Mumbai. Now, suppose this will be quite relevant to you. Suppose, being all of you a startup, you are going, I wish you all the best in your future endeavor. You succeed, you grow, and India also grow. So suppose you start tomorrow a business, and you come across through internet only any of the buyers who is asking for, say, say rice, let me say rice only, a rice from you to be, and suppose you're a trader, you procure rice from some Indian company and all, and you want to export that rice to that buyer, and that buyer is asking on it, say, is saying that I will make you payment after 90 days. That is purely on credit terms. But you do not know anything about the buyer. Can you trust him or her? Can you trust him or her? Can you take that 1 crore shipment value? Suppose its order is worth 1 crore. Can you make a shipment of 1 crore? That is, a startup being and running into losses of 1 crore is a huge amount. So what you do, you approach ECGC. ECGC, I said, country classification that we have done. Now we need to assess the risk on the buyer. The buyer which has asked for a credit of 1 crore, whether that buyer is worth taking a risk of 1 crore. Can that buyer be given a credit of 1 crore? What is its credit worthiness? So what we do, ECGC has impaneled like a tie-up with almost 20 different agencies. Like to name some of them, you might have heard of DNB. DNB is called Dun and Bradstreet, UniCredit Suisse. Then you have MNS, Rubix. There's a Gradon. There are so many companies. So where these are the companies who provide the entire data on the buyer. Now, once the data is received on that buyer, so again, what we do, we have that buyer card scorecard model also. How it functions? It is the prediction on the future financial soundness of the buyer, commercial risk related to non-payment by the buyer, where there has been any instance which has come to our notice, the buyer had made some non-payment or whether he had defaulted in the past. Evaluate the buyer. Now, how you're going to evaluate the buyer before taking an exposure? Basically, it will involve the past payment history or the commodity which is in dealing into, and what is the how that commodity is performing in that country. And absolutely, the most important is the financial of the buyer. Determine the capacity and willingness of the buyer. Set overall limit of the credit for the credit-worthy buyer. Now, what does this mean? Set overall limit. As I said, you asked for a credit limit means when I say credit limit, that means you require an coverage of 1 crore on the buyer, which I on rice when I was talking about. So you come to ECGC and you say that you kindly can you give me an insurance of this particular buyer I have come across? He is asking for a credit terms of 1 crore. Now ECGC calls for a report, and he found that buyer is quietly means financially very sound and stable, and I can take a risk of this say 10 crore in this particular buyer. So what our buyer underwriting department will do, they will set an overall limit on 10 crore on this buyer. Now your requirement for insurance coverage is of 1 crore, we give it to you. Suppose some other exporter, he also comes and say my requirement is 2 crore. He has also placed me with an order of 2 crore. I can give 2 to him. Somebody comes with 5. Somebody comes again with 2 crores. So with this, I have completely exhausted the 10 crore credit limit which was set on the buyer. Now, if the fifth exporter walks to me and say, I also have an order of 1 crore, then I may have to deny to that exporter, no, this buyer was credit worthy of 10 crore and I have given to 4 of the Indian exporters. I cannot have an exposure beyond this point. So sorry, once let these exporters make the shipment, let them realize the payment. If they have some satisfactory experience on this buyer, definitely in due course, we will enhance the limit and then we can give you the coverage. Till the time, if you want to make a shipment, it will be on your risk. ECGC as of now cannot support since it's like the risk appetite on this particular buyer is already full. So how we assess the buyer? It is on the business ability, transactional behavior, its financial strength, and industry outlook. Industry outlook means that how the commodity, what are the commodities they are dealing, the buyer is dealing with, and what is that commodity is faring in that country, and what is like future of the like if we say means suppose let us take an example. Suppose any Indian importer here sitting in India, suppose exporter is say so from any other country, say USA. Now this importer asks for say those 1 lakh pieces of landline phones which we are using. Now, if you see, I don't think anybody is now using that landline phone anymore in India. So definitely when anybody from credit insurance company is going to underwrite risk on this importer from India, he will have this industry outlook that importer is asking for a 1 lakh telephone set, which is not even required in India. Why is he asking for that? Then he may reserve his providing a insurance coverage for this importer in India. So this is what calls industry outlook. That was the underwriting bias or trade reference credit reports, which we call. Then again the character, capacity, and capital. This is also plays the same as we seen in our country underwriting. So this is the buyer underwriting scorecard is the business ability, financial strength, transactional behavior, and industry. This already I explained in my previous slide to you. So these are some of the parameters, what we attach, how we attach. The business ability, we assign 20%, transactional behavior, like whatever transaction they have done in the past. As I said, that we had given a 10 crore limit to four exporter in the buyer, and fifth, we had denied. So what we ECGC would say if it comes to us, we have given, let them gain an experience, and suppose their experience are satisfactory, we will increase our limit, the overall limit on this buyer. So that is called transactional behavior. So 30% the weightage is attached, given to that. Then financial ability is purely the financials, the balance sheet and P&L account of the buyer. And 10% is for the industry outlook. This is how the buyer is assessed. This is some of the key concept of limit setting, how we do. Scorecard derived from DNB. This is something our internal thing, though I have kept in the slide, but it is not as of now. But basically, you got to know how we assess the risk on the buyer and how do we provide the cover on the square. These are some of the scorecard model by which we fix the limit on the buyer. Now, if the buyer scorecard is more than 80, then it's the highest credit worthiness buyer. The limit can be set as per the requirement, but depending upon whatever exposure we are going to take on that particular buyer. Suppose 0 to 30, the scorecard is less than 30, but scorecard populates the score of less than 40, then it would be really very difficult on our part to provide any coverage, insurance coverage on that particular buyer. Now, these are the exposure norms. See, the only thing is that once, because if we are our premium, if you say the ECGC, the risk, what we underwrite is the country risk and the buyer risk. Now, how we do manage the risk? Suppose I have my entire portfolio of buyer are from USA only, and all the buyers are very good, excellent. So I cannot go underwrite all the buyer from USA, and I do not have exposure in any other country. So ECGC also have to manage their exposure also. So what we do, like I said, ECGC classifies the countries into 7 categories: A1, A2, B1, B2. So C1, C2, and D. So A1, A2, B1, B2 is classified are called category 1 countries, and C1, C2, D are called category 2 countries. So if my total, suppose if when I give an insurance cover to any exporter, so I say I have given a value of 10 crore. To some exporter, I have given 300 crore, some to 200 crore. Similarly to the banks, I may be giving, I may have given 5,000 crore, 3,000 crore. So with cumulative, my maximum exposure limit, which of all the sum of the insurance policies which I have given to the banks and then the exporter, is say 1 lakh of crore. Now, my country exposure on one particular category, one country, like from A1, A2, B1, B2, cannot exceed beyond 20,000 crore. And for category 2 countries, I cannot exceed for more than 10,000 country. Now, this is some project exposure. This I will come later on, how it does. So I will be running now a little bit fast because we have to cover. Now, buyer-wise cap. So buyer-wise exposure cap will be if it is a public buyer. Suppose the buyer is the government institution in overseas. So my exposure cap will be 20%. And for the private buyer, it will be 5. Suppose 1 lakh crore is my total maximum exposure limit. For any private buyer, I cannot go beyond 5,000 crore. And public buyer, it can go up to 20,000 crore. And it says exposure norm should be in place for healthy underwriting or reinsurance support. Reinsurance already exposed because for any insurance company, the reinsurance support is very important, which ECGC does not have as of now because our reinsurance support is hardly somewhere less than 20%. Now, till now, the topic of the talk was how we do manage the risk and all. This I explained so far. What are the risks? How do we underwrite the risk? What are the risks involved in export transaction? What are actually the credit risk? Because the credit risk, which one? And what are the things we look when we underwrite any credit risk? When we provide any insurance cover to the overseas buyer, what are the things we look into? This I dealt when I was dealing with the overseas buyer. And in second product portfolio, when I talked about export credit insurance to banks, what the underwriting we do, there we similarly assess the financials of the Indian exporter, whom the Indian banks are giving the loan for the export. So there purely the underwriting will be done on the basis of it. As of now, I should not quote, like suppose see if Anil Ambani's company today, if any bank gives the loan to Anil Ambani's company, definitely ECGC is not going to underwrite that risk. Suppose Nirav Modi's company, the Fire Star company was it named. Suppose if any bank is ready to give that to extend the export credit advances to that company, so ECGCs cannot underwrite that export. Suppose many of the exporters, if you are from Delhi, like Satnam Overseas or Sri Lal Mahal Rice or Shakti Bhog in the past, you might have come across these of the companies. These are an insolvent company. Like promoters of this company open up a new company. So definitely Sri Lal Mahal Rice Mill and Shakti Bhog, they are all NPA account. But suppose, so definitely giving cover to these companies does not arise at all. But suppose the promoters, directors of these companies open up a new company and the bank is ready to extend finance to the new companies started by the promoters or director of these defaulted companies. So ECGC cannot provide a coverage to all those companies. So this is what the underwriting we look into when we see when we provide the insurance coverage to Indian banks against the non-payment by the Indian exporter. Now these are some of the these are some of the schemes which ECGC does have. Like if you see, starting from that orange hexagon, this is called SCR, SEC, MEP. These are, see, the policy again are classified into two types. One is declaration-based policy and one is exposure-based policy. Now, SCR, SEC, MEP are WT. WT means whole turnover policies for small and medium exporters. As these startup are basically for MSME, let me put in record that as of now, ECGC's clientele base, 85 to 90% constitute of MSME. I have not, because I have dealt with MSME. I just want to this is not in my slide. I just want to share one piece of information. Recently, the last year only, ECGC had signed an agreement with the government of MSME, government of India, what does it do? Say, if there is any new Indian exporter, like whose IEC, Importer Exporter Code, is less than 3 years of old, and the exporter is classified as a MSE, medium and a small. So if you have taken a policy from us, ECGC, small, that is small exporter policy, SEC, what we are seeing in the orange slide. So if you have taken a policy from us and you are paying a premium to us, so ECGC will refund you a premium to the extent of 10,000 in a year, which they will be getting a reimbursement from Government of India, Ministry of MSME. This is an agreement which ECGC had signed with. There is a MOU between Government of Ministry of MSME and Government of India and ECGC. So this is some of the incentive we do provide to MSE and the startup company whose importer-exporter code is not more than 3 years old. Now, coming to MBEP, ETP, and CSE, these are the declaration of exposure-based policy. These are designed for the large exporters. Scheme are not going to deal much into, because basically you understood, if you are going to start a new business, if you are going to export, you can always approach ECGC. We are there we are there to help you. If I am going to tell you entire this product, it will further confuse you, I'm sure. So if you still want to have this idea, you can very well connect me one-to-one. I can explain you all the policies. But if you are into export business or you are going to start your business, then you contact the nearest ECGC office, or you can contact me. My numbers are available there with the institute. They can share my number also. So we can suggest you the appropriate policy at the time when you're going to start the business and you have found the buyer. So I'm not going to very much into detail about the products, what do we have. See, this is some of the risk value distribution of the total value what we have covered. Our maximum risk value was concentrated to United States, and these are some of the top countries which we have given wise and continent wise, just for the information. How the export happens from India. These are the major industries supported. So this can just give you an idea which are the industries. Those are doing good. If you're going to start your business, these are some of the areas which we can venture into, because product manufacturing, that is the most important part. See, whatever you whatever you start up, you are going to start. But my suggestion would be, it should be like a value addition thing. Value addition gives you the more profit. But because if you are going to do the regular agri product and food, so the margins are not enough. So whatever product you decide, it has to be the product where there is some value addition. Then only you're going to earn, and your export is also going to grow from India. See, these are the country-wise, the short-term export we do cover. This is just depicted on the world map. Now, short-term cover, again, I'm not going to detail much into the cover. Similarly, I explained about the policy product, which we do have to the exporter. We do have for the banks also. So how does this export credit insurance to banks help them? It enhances the risk management for the bank. The flow of adequate credit to the exporters. Suppose you go to the bank and you ask for a loan from the bank. Suppose you are going to start your new export business. Definitely you will be requiring some fund from the banks. Once you approach the bank assesses your requirement based upon that, your working capital requirement, your non-fund based requirement and all. So bank is ready to give you the loan. So what bank will do? Bank will ask for a certain amount of collateral from you. So if that collateral is not, so ECGC insurance cover to the bank also acts as a collateral to them. Suppose you have taken a loan of 5 crore, if they are asking for a collateral of say 10 crore or 5 crore or 6 crores from you. So if ECGC's cover is available to them, then definitely they will scale down to the demand of the collateral, whatever they require as per the terms and conditions. And then you will have a banks will have a better customer selection through a specific approval list. What is a specific approval list? Like when we say that there is a RBI caution list, ECGC also maintain a specific approval list. I gave you an example of like Sri Lal Mahal Rice just now. That company has defaulted to so many banks. Now all those banks who had given the export credit to this particular company and had taken our cover had reported a default to ECGC. Now what ECGC has done, ECGC has placed all the promoters, directors, partners, or whosoever management of this company, as well as the company into the specific approval list. So what happened next? If some of the bankers come to us and they ask, they have their, they can access it online also if they will come to us. So what will happen? They will also come to know that this particular customer is in a default list or something. They should be like very careful, or they should not extend any loan to this particular customer. Then I already explained the lower margin or collateral securities, lower weight for risk on export credit covered by ECGC. This is something technical thing. I will say that. So as per the Basel III norms, like any bank, whenever you are giving a loan of 100 rupees, you have to maintain a CAR, capital adequacy of say 9% of it. So 9% you have to kept as a buffer. Now, if ECGC cover is given to the bank, so what happened? RBI has assigned 80% of weightage to the ECGC cover. So for 100 rupees of loan, ECGC coverage is 75%. So it's a co-insurance concept. So ECGC coverage is 75%. So when RBI has assigned 80%, that means 80% of that 75 rupees. It means 60 rupees. So 60 rupees of the bank is risk-free. So originally, where they had to provide the capital adequacy of for 100 rupees, say 9% of 100 rupees, now they had to maintain capital adequacy of 9% on 40 rupees because as per the RBI and risk weightage this thing, 60% is their risk free where they do not require to provide this capital adequacy. So effectively 40% say 9%, 3.6. So 5.4 rupees is available with the bank for further lending. So this is something the advantage, lower weights of risk on export credit to the banks. That means increased liquidity for banks through ECGC claim. Then they have to lower provisioning to the extent of ECGC coverage. And post-claim recovery initiative, as I told, they have to share the recovery in the same proportion the ECGC had paid the claim to them. Now, coming to the last part, this is overview of medium and long-term model. See, I'll just come. See, what I said that medium and long-term, when I say medium and long-term export, as already explained, short-term exports where the payment realization is up to 270 days are only allowed only for merchandise export. Now, when you talk about the medium and long-term exports, it is only allowed your terms of payment, your period of realization can extend up to from 1 year to up to 15 years also. But the goods exported should be capital goods or any EPC contract. Let us take an example. Suppose L&T is there. They are constructing any, suppose, bridge in Zimbabwe or Zambia. So if that payment is coming, because the bridge and whatever road or railway line, whatever is constructed, it cannot be constructed overnight. So it will have a period of, say, 2 years, 3 years, or 4 years. So normally these payments are made on milestone basis. But you might be knowing that all this construction linked payment, they keep the 10% of retention money. So even I have constructed the first 10 kilometers of road, say for 10 crores of rupees. So the project owner will release me only 9 crore of rupees. 10%, that 1 crore will be kept as a retention money and then will be released at the end of the project. So the project which I missed, the invoice, because once I complete this project, construct the 10 kilometer of road, I will raise my invoice to that project owner, say the government of Zimbabwe. The government of Zimbabwe will make me the payment on basis of that invoice. So my shipment date will be for that project will be, my date of invoice will be my shipment date. But the final 10% will be coming only after 4 years of completion of that project. So what I mean to say that the payment terms exceeding 1 year, realization period exceeding 1 year, is only allowed for this. This is EPC contract or export of capital goods, or this is also called a project export. You have a different project export memorandum published by RBI, where it stipulates the guidelines for how the project export can be done. What are the regulators' guideline pertaining to that? So in this case also, like economic risk is scorecard method is attached 30%. 20% is political risk. Economic and political relationship with India is 10%. ECGC experience 5%. Burn Union is 5%. Forecasting 20%. How this risk is means we assign the risk to it. Now, this is something not very this thing, but just I will tell you what is this National Export Insurance Account. See what happened in 90s in Iraq, almost all the Indian project exporter when I say the like L&T is the project exporter, Kalpataru is the project exporter, Ircon is a project exporter, और एफकॉन्स और जे कुमार और ये जो आप लोग देखते होंगे रास्ते में जो रोड बोर्ड बना रहे हैं वो सब प्रोजेक्ट एक्सपोर्टर कहलाते हैं. सो इन 90s में so lot of people were doing this project exports, either constructing railway line or bridges or roads or anything in Iraq. So what happened? That Gulf War broke out. Saddam Hussein captured Kuwait, then USA attacked Iraq, and everything was like devastated. So all the projects were installed and the people had to come back to India. So in those days, what happened? ECGC's premium income in 91, 93 was hardly 100 crores of rupees. So in those days, what happened? ECGC paid a claim of 800 crores to various exporters who suffered a non-payment in Iraq. So that was something very catastrophic from ECGC. Now, however, ECGC survived, but it was felt if any such thing happens in future, so ECGC's existence would have been in threat. So they were requesting the government of India to, because in everywhere in the world, this medium and long-term export, the insurance provided to promote this project export from any country is underwritten on the state budget. No private company, like in credit insurance, the short term, in India also there are some private insurers which provide credit insurance, but medium and long term, no credit insurance company across the globe, private, will provide you. It is written on the state budget. So ECGC also requested that this project export should be provided by the government of India. So in 2006, this National Export Insurance Account was set up. It was set up by the government of India, and it is under the fully control of, owned by Ministry of Commerce. ECGC only manages this trust. Now, what is the role of this? Suppose there is a company called L&T who wants to undertake a project in, say, Ghana, where they want to construct, where the government of Ghana has given a contract to L&T to construct a railway line, say, for 300 or 400 kilometers, where the cost of project is $500 million. Now, L&T is not very sure whether my payment, government of Ghana will honor my payment or not. So they come to ECGC that I have a 500 million. So 500 million is, as of now, it's 4,000 crore. I want to undertake a project, but you provide me an insurance cover. Now, ECGC on its own cannot provide a cover of 4,000 crore because of its capacity constraint. So what it does, it draws a support from NEIA. It goes to the NEIA, says, you see, I want to underwrite this project of 4,000 crore, but I have only my capacity, I can underwrite only 100 crores. So I want a support of 3,900 crores from you. So if tomorrow any claim happens, so out of 4,000 crore, 100 crore I will bear, and 3,900 crore you take in your books. And whatever the amount is payable to you, suppose I have taken a premium of 10 crore, I am passing you 5 crore or 6 crore or 7 crore, whatever it is, I am passing it to you, but you take a risk on, means you share the risk with me. So this is the main function of the NEIA trust. So ECGC, so far through NEIA trust, has supported 241 projects through 359 covers. And you can see this slide, we have covered the cover of 42,399 crore. And last line is export of 16,924 crore supported through buyer's credit scheme of NEIA. Now, what is this buyer's credit scheme? See, what happened is that you might have heard that whenever our Prime Minister, Honorable Prime Minister he goes to any country, not this Prime Minister, in previous also, we could see in that, like, we have given $1 billion to, hello? We have given like 1 billion to government of Sri Lanka, 1 billion to this country. So what is actually 1 billion? It's not a loan. It's a line of credit. When we say a line of credit means we have given 1 billion to government of Bangladesh. When I say it's line of credit, that means I have given 1 billion for development of infrastructure in your country. But that 1 billion, whatever infrastructure development you are doing in your country, that has to be done by some exporter from India. It cannot be like you can take a help of China. That's what I'm giving you 1 billion right now. Suppose you want to construct a dam. So it has to be some company from India that's going to construct a dam. So out of 1 billion, suppose 100 million is utilized for building that dam. So XYZ company from L&T from India goes and construct a dam. So as L&T construct the dam, he is paid that $100 million. Now that $100 million turns into loan from government of Bangladesh. The government of means normally line of credit is extended by Exim Bank of India. Now that $100 million, because it is based on the availment. Now 1 billion is the total amount but the government of Bangladesh has not availed. So 100 million is a loan from Exim Bank of India to government of Bangladesh, which they will have to repay, say in next 25 years, 20 years, whatever the agreed terms of it. So this line of credit, the government of India was extending to its friendly nation. But there are some countries where India was not having that friendly relation with those countries, but our Indian exporters were going there to negotiate the contract in that government country. Let's say an example, I'll give you an example. Suppose in case of Tanzania, the government of Tanzania wanted some, let's say, supply of some buses and jeeps and all for their boosting their police forces. So Ashok Leyland went there. Ashok Leyland spoke to the government of Tanzania, yes, I can supply. But government of Tanzania was not having sufficient fund. So they asked Ashok Leyland, can you arrange me a funding also? So what Ashok Leyland did, they approached Exim Bank over here. He gave the entire project details to the government, Exim Bank. Exim Bank studied the report and said, yeah, fine, we can fund this project. So there was an agreement between the buyer's credit between the Exim Bank of India and government of Tanzania. So Ashok Leyland supplied the buses to the government of Tanzania. The government of Tanzania, as and when the buses were received, they certified, yes, I have received the buses. Based upon their certification, Exim Bank India here released the payment to Ashok Leyland. So suppose say it was a $50 million. So in 2 years, the entire supplies of that $50 million was made. Now $50 million now becomes a loan from it. In this process, what happened? The Indian exporter gets the payment, export has taken place, and then this $50 million becomes a loan from Exim Bank of India to Government of Tanzania, which they have to repay in 10 years, 12 years, 7 years, whatever it is, agreed terms of payment. Now suppose Government of Tanzania doesn't pay to Exim Bank, what will happen? So for that, Exim Bank has taken an insurance cover from NEIA, because to cover such a voluminous, such a high value project, it is not beyond the capacity of ECGC. So what, in this case, what had happened? NEIA, in collaboration with ECGC, had provided cover to Exim Bank of India. So here, that is why I wanted to explain what is this meaning of NEIA. NEIA was formed to support the project export from India, where the ECGC was unable to underwrite such high value project because of its constraint. So this NEIA was formed, and it is supporting the ECGC out directly also to promote project export from India. So these are some of the countries. If you see, we have supported in Iran, Uganda, Tanzania, Zambia, Mozambique, Zimbabwe, Cameroon, Ghana, and then Ivory Coast, Senegal, Suriname, Mauritania. These are some of the countries which we have supported. And this is my last slide, where we got Jamna Lal Bajaj Award for Fair Business Practices 2023, and this is our erstwhile CMD accepting PO Niryat Bandhu Gold Award for 2023 from the hands of Honorable Minister for Commerce and Industry. So with this, I have completed. If you have any queries, you can feel free to ask. And sorry, I have exceeded just a few minutes extra. With that, I am done.
Thank you so much, Rahul ji. Am I audible?
Yeah, very much, sir.
There are some queries from our participants.
One second,
the first
sir.
Query is,
one second, sir.
Is there a limit of DICGC guarantee?
Domestic, it's handled by some other agencies. It's not done by ECGC. Domestic Credit Insurance Guarantee is not our. It is some other DCIGC. They take care of it. We do not provide this type of cover.
You mean to say it is not your coverage area?
No. It's not our coverage area.
Okay. Another question from another participant is, briefly explain with or without recourse to buyer clause in LC. Briefly explain with or without recourse to buyer in closed LC.
In closed LC?
In closed LC, letter of credit. Letter of credit में जो क्लोज होती है विद और विदाउट रिकोर्स, उसके बारे में समझना चाहते हैं.
से एलसी जो है कभी भी कंडीशनल नहीं होती है. विथ रिकोर्स अगर एलसी है तो उस एलसी को आप एक्सेप्ट ही मत करिए. एलसी हैज टू बी विदाउट रिकोर्स. एलसी में टर्म्स एंड कंडीशन स्टिपुलेटेड रहेंगे कि आपको क्या क्या डॉक्यूमेंट्स जमा करने हैं, आपकी लास्ट डेट ऑफ शिपमेंट क्या है, आपको डॉक्यूमेंट्स कब तक जमा करने हैं. अगर एलसी में कोई भी कंडीशन स्टिपुलेट हो रहा है, don't accept that LC.
And another question is, sir, what will be the charges for insurance to cover these risks?
Sir, again, as I said, it's, the premium depends upon two things. One will be your terms of payment. As I said, advance में तो premium नहीं लगेगा, उसमें कोई risk नहीं है. DADP और LC है, और किस country में जा रहा है. Then it again depends upon the type of policy you are opting for. Suppose आप whole turnover policy ले रहे हैं, जब आप सारे के सारे बायर कवर करा रहे हैं, तो डेफिनेटली वहां पे प्रीमियम कम होगा. अगर आप बोलते हैं कि मुझे एक पर्टिकुलर ही शिपमेंट करानी है, आप सबसे अब जो रिस्की बिजनेस है वो मुझे दे रहे हैं, तो वहां प्रीमियम हाई होगा. वहां अगर आप कहते हैं कि नहीं, मुझे ये एक ही बायर है जिससे मैं साल भर का काम आपसे कराना चाहता हूँ, तो डेफिनेटली वो उसके बीच का होगा. तो प्रीमियम कई सारे फैक्टर्स पे डिपेंड करता है। एक तो होगा कंट्री क्लासिफिकेशन, दूसरा होगा कि आप कौन सी कंट्री में कौन से टर्म्स ऑफ पेमेंट पे काम कर रहे हैं, तीसरा होगा कौन सी कंट्री कौन सी पॉलिसी आप ले रहे हैं। तो ये एक लंबा मैट्रिक्स है। तो आउटराइटली अगर आप मुझसे पूछिएगा क्या प्रीमियम होगा, तो ये तो मैं नहीं बता पाऊंगा। इन 3 फैक्टर्स पर डिपेंड करता है। तो अगर आप, क्योंकि मैट्रिक्स होता है, क्योंकि प्रीमियम ऐसा नहीं होता कि एक फ्लैट रेट कोई, ये मैट्रिक्स है। जो जब तक ये चीज पता नहीं चलेगी आपकी पॉलिसी क्या है, आपकी कंट्री क्या है, आपका टर्म्स ऑफ पेमेंट क्या है, तो ये प्रीमियम बताना अक्रॉस थोड़ा टफ होगा। टफ नहीं होगा, इम्पॉसिबल होगा।
अगला क्वेश्चन है सर, एन ईसीजीसी इज ए इंश्योरेंस कंपनी, how they can drive recovery income from banks from the sale proceeds of collaterals of corporates, because if the insurance amount is paid, then bank have to knock off the liability of the corporate firm in their books.
It's not like that. If you have a collateral, suppose that's the ECGC, when it pays the claim, banks keeps that amount in their suspense account, because the recovery or the legal recourse still is there. They can adjust their liability by ECGC claim once the account is final conclusion पर नहीं आता है. They do not write off this account. So once the account is written off in their account, then only they can adjust the ECGC claim. Till then, they have to keep their account in suspense account, amount in suspense account. And उससे पहले, before write-off से जो भी पैसा उनके पास आ रहा है by way of selling or disposing the collateral, they have to share with us in the same proportion we have paid the claim, because they cannot have a recovery from both the ends. ECC claim ले लिया, रिकवरी भी ले लिया. अब बड़े अकाउंट की बात करिएगा, जैसे आप बता रहे हैं कि हम बड़े अकाउंट्स की बात करें, तो जहां पर अब लोन 500 करोड़ का है, वहां पे कोलेट्रल कितना होता है? 10 करोड़, 20 करोड़, 30 करोड़. वो तो छोटे छोटे एक्सपोर्टर्स होते हैं, वहां पर आपका कोलेट्रल एक्सीड करता है आपका. और अदरवाइज कोलेट्रल तो कम ही होता है ना नेचुरली. एंड कोलेट्रल्स एट द टाइम ऑफ टेकिंग अ लोन, आप एक घर की कीमत दिखाते हैं 5 करोड़ है, जब डिस्पोज करने जाइएगा तो वो तो आधे दाम से कम बिकता है. तो वो भी एक मतलब इसमें एक हिकअप है इसमें. तो जब तक बैंक राइट ऑफ कर दे उसको, अगर उसको कोलेट्रल से कुछ भी पैसा नहीं मिल रहा है, दे कैन एडजस्ट द एंटायर ECGC अमाउंट. ECGC does not stipulate that you need to have a collateral. ECGC does not stipulate. It's bank their own sanction terms and condition. उनका अप्रूवल है. ECGC जब बैंक अपना अप्रूवल देता है, ECGC is nobody to dictate their terms and condition. उनको कितना सैंक्शन रखना है, ये रखना है. ECGC cover acts on an added collateral, additional collateral. अब collateral अगर उसने ले भी लिया कल के डेट में, तो उसका डिस्पोजल यू नो कि हाउ द इंडियन सिस्टम में हम क्या करते हैं. It does not happen overnight. It may take 2 years, 3 years, 5 years, 10 years. By the time they take a ECGC claim, और अपनी जो प्रोविजनिंग है, अपनी जो ये है, वो कम कर सकते हैं उससे.
सर नेक्स्ट क्वेश्चन है, विद इन हाउ मेनी डेज फ्रॉम द एक्सपायरी ऑफ ड्यू डेट ECGC will pay the claim amount to the exporter? Is there any time limit exporter has to wait to be eligible to lodge claim with ECGC?
See, the waiting period for ECGC claim, suppose today is 21st March and somebody has made the shipment on say 90 days. So if you count 90 days from now, to 21st April, 21st May, 21st June. So 21st June is the due date for making the payment. So there is a waiting period for 4 months. So exporter can lodge a claim only after, till that time he had to follow for the recovery. July, August, September, October. He can file a claim after 21st October. But not later than 360 days from the due date. But if the buyer becomes insolvent, he has gone bankrupt, then this waiting period reduces from 4 months to 1 month. Then in this case, exporter can file a claim from 1 month from the due date, from 21st June to 21st July. he can file after 21st of July. In case of insolvency, but in case of protracted or willful default, the waiting period is 4 months.
And the next question is, sir, can co-insurance be selected by the customer?
No, it's like defined in every policy. Indemnity is defined in whole turnover policy is normally 90%. In a selective basis of policies, 80%. Those are pre-decided. But yes, if you want a lesser amount of insurance cover, that can be given, but higher amount cannot be given. 90% is the maximum coverage what we are giving.
And another question is country risk, whether it is on FATF risk model. I think question is not
That
clear,
is
sir.
one of the political. Hello.
Yes, sir. Yes, please.
FATF can be one of the factors. It is not to do with. I had explained in the country risk this thing. We have defined the parameters. One is economic relation, one is political situation of that country, then it is economic and political relation with India. Then you have the political stability, then its relation with its neighboring countries. There are some of the parameters on which the country classification is decided. Now we have included the IMF debt sustainability also. That is also looked into while deciding the country classification.
The last question is, in case of pre-shipment credit, if not liquidated within 1 year, then interest subvention from RBI is at the rate of 3% on MSME is refunded to RBI, or any other penalty to bank by RBI.
I'm not aware of any such penalty. The interest subvention, whatever has been passed, that has to be repaid back, given back to the, not RBI, it has to be refunded to, because interest subvention is the domain of Ministry of Commerce. So Ministry of Commerce releases this amount. I don't think there is another penalty, because normally when interest subvention, that is, it becomes a normal rate of interest. So there could be some penalty also, because after 1 year, if the PC is not adjusted, then higher rate of interest may apply, the commercial rate of interest. Because normally interest subvention is bank prime lending rate minus 3%. So in case the loan is not repaid, so the higher penal interest bank may charge. It is pure like the domain of the bank. So I'm not the right person to really comment on that. But this is what I know. This is based on my experience and all I am sharing.
Thank you so much, sir. I think we have replied answer to all the queries raised by the participant. And sir, thanks so much for spending your valuable time and
The pleasure
wonderful
was mine.
deliberation on this very new topic for Chartered Accountant Fraternity. In my personal opinion, only few chartered accountants are involved in practice of this export insurance or export credit. So I think definitely every member who is in this practice can enlighten with your words. Thank you so much for spending your valuable time, sir, once again. So thank you
so much, sir. But only thing I hope at the last that I was clear and I was able to explain the things in a very layman's language. So I don't know how, because in this I could see only 4 or 5 people are there. I don't know how.
You have tried your best. I am listening from last 2 hours. You are make your presentation so simple so that a person like us who are more understanding this topic can understand the things. So, sir, thanks once again for wonderful deliberation.
Thank you.
We are wrapping up the session. Thank you.
Okay.
Thank you, sir.